I think the most important thing is that peak hawkishness is going to come probably towards winter months. I think there is a case for front loading the rate hikes that we've seen with the US, with the Federal Reserve, but also what we're going to see today with the Bank of England. Of course, when winter months come, there will be high uncertainty in terms of how the weather is going to turn out, in terms of the squeeze on consumer real incomes because of the high energy prices. So that's why we're seeing these jumbo rate hikes by the US, by the UK, to be prepared for those months ahead.
And I mean, is it accepted wisdom now that we are going to have to see a recession and we are going to have to see some job losses before the central bankers begin to believe that their work is done?
Look, I believe so. This is true, especially for the US and for the UK. I mean, just to give you a sense, in the US, we have 11 million jobs and 6 million unemployed. So the Fed needs to see that unemployment rate go higher. It's true for the UK as well, for those high wage pressures to come down. This is extremely important. And to your discussion earlier before as well, people always look at the magnitude of rate hikes. But I think what is missing here is that the duration for those restrictive policy in terms of bringing, again, inflation down as well. I think that what they will do is that stay in this restrictive policy environment for longer than what the market is expecting at the moment. That's also very important. So we will see rates at around 5% for a period of time in the US.
Lale, very good morning to you. I'm sorry, I'm not buying the restrictive rhetoric from anyone at the moment. When you have US inflation with a high 8 handle and higher in some parts of the curve as well, and you've got interest rates that will peak potentially at 4.6 to 5%, that's not historically restrictive, is it?
Well, look, I mean, of course, we're in a different environment at the moment in terms of, again, understanding that this is a recessionary environment where the pressures are coming from the war in Europe and the energy dependencies from Russia. So I do believe that in and of itself is putting a lot of pressure on consumers. So keeping rates at 5%, and of course, that energy prices putting pressure on consumers, I believe, would be a recessionary environment and therefore a very restrictive environment in terms of central bank policy making as well. Again, the duration is going to be important in terms of staying at those restrictive levels. We're not going to be in 1970s type of an environment where they're going to say, stop and go in terms of their interest rate policy. They will hike and they will stay at those levels.
But we are in 1970s levels for inflation already. So, again, I'll make the point again, Lale, because we are not in restrictive territory. I hear what you're saying about the pressure it will put on consumers, but when you've got rates which are lower than the rate of inflation and are expected to stay lower than the rate of inflation, that is not anywhere near real positive rates, which some people believe are necessary to tame inflation.
I mean, of course, the central banks are looking to see whether inflation is going to come as well. I mean, that lagged effect that you were talking about before, it's going to come during winter months, in my opinion. So at some point, they're hoping that actually inflation is going to come below those rate hikes that we're seeing at the moment, and that will be a restrictive environment. That will take time. So again, the case for jumbo rate hikes right now to see whether inflation is going to come down during winter months and therefore whether that will create that restrictive environment that we're talking about.
Hi, I'm Joanna Bersecci and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.